Good morning, everyone. I'm Mike Burns. I'm the partner in charge of the not-for-profit practice in New England. Craig, if you break that coffee cup, it's $25. Welcome. Welcome to the session. I'd like to welcome first-time comers here and those of you that are reliable attendees. Thanks for coming out. I think we've got two very important subjects to review with you all today. Of course, we like to talk about things that affect you and are of issue in your organization, and certainly the IRS is one of those impacting parties. As many of you are aware, we recently distributed to you all the recently issued college and university final report on their examinations of a number of colleges and universities. And there's direct applicability to all of you in this room. There are lessons learned. So we're going to go through that at some level. We're going to go through the IRS work plan from our capable colleague, Klein. And we also are going to talk about the Health Care Reform Act a little bit. And while that's been perking its way through, I think the best is yet to come. Is that fair to say? Or the worst is yet to come? I'm not sure. We have a number of you who are in higher education in the room here today, or secondary schools. I think there's some special complexities there. There's a lot of work to do here. And a message to you all is there needs to be a little bit of a partnership between HR and finance in considering the implications of these things. So I'd first like to welcome Klein to the podium to go through the recent developments on the tax side to give you that exciting primer. And what did you say? I had to say the glorious update on taxation and IRS matters. Craig?
Thanks, Mike. Good morning, everybody. Welcome. So glad to see everybody. I thought I might break the ice by showing the video of the IRS seminar where they were all line dancing. I thought that would help break the ice this morning. But Mike tells me we don't have time for that. So my marketing folks really want to tell us about this. Kristen? Thank you. Okay, so this is our program this morning on tax developments. Mike stole my thunder just a little bit. First, we're going to talk about the college and university project final report, which was just issued in April of this year. Now, we're going to start with a little quiz. We're going to see who is paying attention to Mike. Now, the college and university project is only applicable to colleges and universities, right? It has no applicability to any other organization in this room, right? Wrong. The college and university project, certainly the final report, is all about UBI, and it's all about setting executive compensation. And those are, or those should be, subjects, topics that are that should be near and dear to every organization in this room. So please pay attention. We'll talk about the IRS work plan. Every year, the IRS publishes a list of its new and ongoing projects that it's going to focus on during the current year. And I'll focus on highlights of the work plan that would relate to organizations here in the room. We'll give a quick update on the executive pay discussion. I'll make my last plug for everybody to file their FBARs on time. That means today. And certainly we'll have time for questions at the end. And I'll certainly invite questions as we go today. Okay, so on the college and university final report, just to recap, this was the culmination of the project that we've been talking about since 2008. In 2008, the IRS issued questionnaires to 400 randomly selected colleges and universities. Of the respondents, they selected not randomly. They selected 34 organizations for examination. I say not randomly because they were selected specifically because of indications in the questionnaires or indications in the 990s of potential noncompliance within the areas of interest to the project. Since the organizations were not randomly selected, we're told that you can't extrapolate the results to the whole population, but the themes are certainly clear. The messages are certainly very clear. The examinations focused on UBI and on setting executive compensation. So was it worthwhile to the IRS? Let's look at the results. Of the 34 colleges and universities that were fully examined, they found the IRS made increases to UBTI for 90% of the colleges and universities that were examined, increases to UBI of $90 million across the 34 schools. Separate fact, they also disallowed $170 million in losses and net operating losses. Now, being an accountant, I can't resist the opportunity to add things up and apply tax rates. That's about $3 or $4 million of tax on average, or potential tax on average per organization, if all those NOLs would have been used at some point. The areas of attack. The IRS attacked, the reasons for the adjustments were disallowance of expenses, and reclassifying of exempt activities as unrelated. They also corrected errors in computation or substantiation. Fully 1/3 of the returns of the 990Ts that they examined had errors in the computation of the losses or in the substantiation of the losses. I find that one a little perplexing, but we're going to focus on these reasons in order to give you a better picture. So, again, we're going to talk about disallowing expenses first. What the IRS found when they did the examination, 70% of the organizations examined had reported losses from activities that generated consistent losses for many years. As a matter of law, here comes the IRS logic. This is the IRS argument. As a matter of law, UBI must be generated by a trade or business. As a matter of law, an activity qualifies as a trade or business only if it's engaged in to make a profit. So, what the IRS concluded, and we knew this was coming, this was signaled in the interim report, the IRS is taking the position that a pattern of repeated losses from an activity is generally sufficient to show a lack of profit motive. And what does that mean? What does that mean if there's a lack of profit motive? The activity is not an unrelated trade or business. And if the activity is not an unrelated trade or business, then guess what? We don't get to take losses and apply them against other sources of taxable income or carry them forward. Applying this logic, more than $150 million of NOLs were disallowed from just the 34 colleges and universities examined. Any questions on that so far? Okay. So the first prong was on lack of profit motive. The second prong of the IRS attack is on improper expense allocation. Now remember, unrelated business taxable income is the income, the revenue from your unrelated trades or businesses, less your allowable deductions. So the question comes back to, well, what are your allowable deductions? You are allowed to allocate expenses. You need to do so on a reasonable basis. The expenses offsetting UBI must be directly connected. What the IRS, as a result of the examination, expense deductions were disallowed on more than 60% of the Forms 990T examined because of improper allocations between exempt and unrelated business activities. So we saw an attack on profit motive. We saw an attack on expense allocation. The third prong of their attack, nearly 40% of examinees were found to have misclassified activities as exempt, meaning in the IRS's view, unrelated trades or businesses were undertaken but not reported as such on the Form 990T. And coincidentally, whereas the IRS finds us all reporting our loss activities on the 990T, what the IRS found is that the unreported activities only seldom had losses. Fewer than 20% of such activities had losses. So that by classifying activities as unrelated, they are increasing unrelated business income overall. Next steps. The IRS, in their final report, indicates they plan to focus on UBI more broadly, and especially on recurring losses and allocation of expenses. No big surprise, since obviously it was so productive for them, at least relative to the examinations during the project. Very specifically, the next bullet is right out of the IRS work plan for the current year. Specifically, according to the work plan, they are going to select organizations for examination which reported substantial gross UBI for 3 consecutive years, but which never pay tax. So that's the next step in this path, in the application of these positions that the IRS has taken during the college and university study. Any questions thus far? Okay. Enough about UBI. Compensation. I mentioned in my opening remarks that one of the areas of examination during the project was on compensation setting procedures. The examinations specifically, they focused on compliance with the intermediate sanctions rules. These are the rules which codify the fact that you can't pay more than reasonable comp to your disqualified persons, your officers, directors, trustees, and key employees. There was exploration of the rebuttable presumption of reasonableness. I suspect most of you are aware, rebuttable presumption is that safe harbor that organizations can obtain when they set executive compensation. You can advantage your organization if you do certain things when you set executive comp. One, if you set comp based upon independent or by independent persons, reliance on good comps, and what we call contemporaneous documentation. So the IRS focused during this project on compensation setting procedures and on this rebuttable presumption of reasonableness. And nobody can fast forward. What do you think they found when they examined compensation setting procedures? Was it good, bad, or ugly? Any thoughts? It was pretty good, actually. What they found was that most organizations attempted to meet the rebuttable presumption standard. In fact, 94% of officers, directors, trustees, and key employees at the examined institutions had compensation set using a procedure intended to satisfy rebuttable presumption. They found broad existence of compensation policies. They found significant procedures designed to avoid conflicts of interest. This is back to that principle of having independent persons set compensation. And they found reasonable documentation of the compensation setting process. So that's all pretty good. That's all really good news. The problem is that it's a 3-part test. Set comp by independent persons, document the process properly in accordance with the Treasury regulation. There's that third prong, and the third prong is the comparables prong, relying on appropriate data. What they found was that about 20% of examinees failed to meet the rebuttable presumption standard because of problems with their comparability data, including inclusion of institutions not similarly situated to the school relying on the data. failure to document the selection criteria for the schools that were included, or why those schools were deemed comparable to the school that's relying on the study. And reliance on studies that were not clear as to whether the reported data in the study was just compensation data or included or was fully loaded with benefits and so forth. There's actually several bills in the pipeline now that would affect either board compensation or executive compensation. Just a few highlights here. The first House bill would limit executive salaries of state-funded nonprofits. The second House bill here would prohibit compensation paid to independent directors. The third bill, the Senate bill, is the bill put forth by Senator Montini, would prohibit public charities from compensating board members, would impose limitations on executive compensation at charitable entities. But what's interesting, the law or the bill is written in such a way that that charitable organizations could seek a waiver. But interestingly, were this bill to advance, if you were to look for a waiver, so again, this Senate bill would prohibit board comp and it would limit executive comp. It says you could get a public hearing if you want to obtain a waiver. But imagine the waiver process, the public hearing would be with the Inspector General of the Commonwealth, with the Secretary of the Commonwealth, and with the Attorney General in a public forum. So it sounds like quite a process. And my final plug here, I know some organizations in this room have foreign financial accounts. And as you know, the FBAR report is due by June 30th of every year, where if you had foreign aggregate balances in excess of $10,000 during the prior year, you need to file this report. The report is due June 30th. There's no mailbox rule here. The report is due June 30th. Only because June 30th falls on the weekend, the report is due tomorrow. There are some nasty penalties that you should want to avoid. So my best advice is, if you haven't had a chance to deal with this yet, get it done today and send it in through an express service that will guarantee delivery to the Treasury, I think up in Michigan, by tomorrow. Any questions? Any questions on anything we've talked about? If, please.
Since you've had a lot of time to think about it, can you tell us the effects to people in Massachusetts of the Supreme Court decision yesterday to repeal DOMA? For instance, we have imputed income on same-sex employees, people who are married same-sex.
I'll be honest. It's very interesting. I had the same thought. Haven't had a whole lot of time to think about that. Any other thoughts? I'll be happy to chat with you afterward about it. Okay. With that said, Mike, would you like to introduce the next presentation?
Yeah. Thank you. I suspect there'll be some guidance on that. I did hear on NPR this morning that they would be advising people, this doesn't deal with employment taxes, but people could amend their individual income tax returns for the last 3 years. Again, this does not relate to domestic partners. This relates to married individuals under state law. So that's different than domestic partner benefits, which many of you as employers may offer. But more to come on this. This will be a fine mess for the balance of the fiscal year. Maybe will be good for our business. We don't mind that, right? A little regulatory mayhem. As Craig said, I do think there's a critical takeaway, and I just want to reiterate it here for one moment. I think the IRS report on colleges and universities is a call to action to each of your organizations. Craig recommended to you that you consider doing an internal risk assessment on your particular organization, whether any of the elements or components of those reports present risk to your organization. If I were sitting on your audit committee and was duly informed about the existence of this recent report, I might ask you a question. Have you considered the contents of the report and the applicability to our organization and whether we are in a good position or not? For each of you to look brilliant, and we want you to look brilliant in front of your boards, if you take this on proactively and go in your fall meetings or whenever your next scheduled interval is, I think you have another opportunity to be proactive with your board in showing that you're minding your P's and Q's. So Craig recommended engaging the audit committee. I wholeheartedly recommend you engaging that audit committee. Go to them in the next 3 months, tell them you looked at the report, tell them you've made an assessment, and let them know what the corrective measures are, if any, that you might need to undertake over a reasonable period of time. This is not a case where we should let sleeping dogs lie. There are lessons learned here. They're on the warpath, and they're temporarily a toothless tiger, perhaps, at least in the Cleveland office. But we have no reason to believe that the audit and enforcement divisions have lost their teeth. So, and their work plan is an indication of that. So I would just echo those remarks, Craig. The second half of the program, and certainly I think this is going to be far more pervasive in terms of the impact, because I had the benefit of hearing this presentation the other day. Ain't we got fun? Both Bernie Kaplan and Ed Belt are in our organization. For those of you that know Bernie, Bernie helps our clients with various benefit plan issues. There are certainly direct implications of that from the Act. And Ed helps clients design insurance programs that are smart and advantaged and cost efficient, and has done so for many years, and is the president of our subsidiary that does so. I hope they can provide you some insights today. There's some really good slides in your book today that you may want to take a look at as you embark on this. I think the call to action here is you folks need to be allocating some serious management time to this in the coming weeks and months. You should not wait to the last second. You may not be able to react in time. And there are some very messy areas that I think you're going to hear a little bit about in a few minutes, some of which we don't have regulatory definition on yet. So with that, I'd like to invite Bernie up to the podium first, and then Ed will follow on. And I guess Bernie is a code head. Is that what you said, Craig? So he's another techie, and that's what an accounting firm is a compilation of. So welcome, Cody.
Well, thank you, Mike. Well, good morning. As Mike said, I'm going to be discussing the Affordable Care Act, and Ed will be discussing the Affordable Care Act too. I'll be giving some technical background on it, and then Ed will have some ideas on solutions. Before I get into the Affordable Care Act, I want to talk about an IRS initiative that has just begun in the retirement plan area. There's a new compliance initiative where letters are being mailed as we speak related to 457 plans. So for those of you that sponsor 457 plans, you may be getting a letter from the IRS with a questionnaire on the 457 plans. So obviously be very careful on how you answer the questions because you may have a knock on the door from the IRS after completing this. And certainly we can help anybody with completion of that letter if you need it. Now with that, I want to get into the Affordable Care Act. All right, and I'm first going to talk about items that you need to be aware of for 2013. We have a deadline coming up very quickly that you need to be concerned with, some of you. Then I want to talk about 2014, what will take place there, and then just a little bit on the future. Now, the law itself, the Affordable Care Act, was 2,400 pages long. and that was considered to be only a skeleton of a law. There will be regulations issued for years to come, which will really provide guidance that we need with the Act. So we have limited guidance at this point in time. There's been some regulations issued. A lot of it in compliance right now is good faith compliance based on what we have in the law. So this is new for everybody. And obviously with 2,400 pages of the law, I have 15 minutes just to give you a brief overview of some of the things you need to be concerned with. Now, the first item to be concerned with is the PCORI fee that is coming due as of July 31st this year. PCORI fee is it's a tax that employers that have self-insurance will need to pay this fee by July 31st, and the fee is paid electronically. There is no extension on this. Now, this is taking notice currently only because the IRS just revised the tax form to pay this fee. It's Form 720, and they just came out with a revised form 2 weeks ago. So for anyone with self-insurance, you need to be completing this at this point in time and paying $1 per individual that's covered by health insurance. And again, anyone that would like help with that, if you have self-insurance, we can help you. Fully insured plans are subject to this as well, but the insurance companies will take care of the filing for fully insured plans. So if you're fully insured, you don't need to worry about it. It's taken care of. Next item for 2013, as a reminder, flexible spending accounts are limited to 2,500 now, not 5,000. So be certain that you're capping all individuals at 2,500. And also, you should amend your flexible spending account plans to have that cap in it. So you do have time to amend, but it's advisable, get it taken care of now so that you don't forget. All right, a question? The 5,000 cap is gone now. It's 2,500. All right. Next item to remind people of, there's an increased Medicare tax now of 0.9% for earnings over $200,000. For anyone earning more than $200,000, you are withholding the additional tax for your employees. And now I want to get into what you should be doing for 2014. How many of you have started to review your health plans that you offer to employees? All right, that's very good. So a number of you have gotten a jump on that. Very important that everyone review your health plans at this point in time. You need to be in compliance for 2014. All right, this, for many of you, you may already be in compliance, particularly since Massachusetts already had required health care. So you may be in compliance, but still the federal law is a little bit different, and you may have to make adjustments. And so if you haven't started to review your health insurance offered to employees, you should do it now. All right, beginning in 2014, employers must provide minimum essential coverage to employees that is affordable and provides minimum value, or the employers will pay additional taxes. This is referred to as the pay or play provision. It's shared responsibility, where the employer is sharing responsibility in providing coverage for employees, and it's pay or play. There are many employers, and you've probably seen articles on this, where they've decided that it's cheaper to pay the tax than it is to comply with the law, and that's perfectly acceptable if employers decide to do that. All right, but that's why you need to review your plans now to make a decision. Are you going to pay the tax, or are you going to come in compliance in providing insurance to the employees? All right, so the new law will apply to employers who have at least 50 full-time employees. And full-time, it's different than for your 403B plan. For your 403B plan, you know that it's basically those that are expected to work 20 hours a week or 1,000 hours a year. Well, health insurance, instead of having uniform rules, we have 30 hours a week or 130 hours a month to determine full-time status. All right, now the government provides guidance on how we count hours, because in many of the organizations, we know that, that you look at it by classification of employee versus actually counting hours. So the government has provided guidance on how you count hours. All right, and there's different categories of employees. We have full-time, those that are hired to work 30 hours a week or more, part-time, working less than 30 hours, seasonal, which is challenging, hired for less than 120 days, or variable, where the hours are not known at the time of hire. All right, so for purposes of determining the hours, we look at actual hours paid, and we look at paid hours that are not worked, such as vacation time, sick time. All right, now the different methods we have for counting hours, for hourly employees, it's easy. We add up the hours they work. All right, but for some of them, it may not be as easy if they're not paid by the hour. So we might look at a day's worked equivalency, where we consider that they work 8 hours for any one day that they work, where they even might only be working 1 hour a day. We consider it to be 8 hours. Or we use the week's worked equivalency, where we give them credit for 40 hours a week, when they may only be working 1 day a week. We can use any of these methods. And these methods are provided because it may be difficult to track employees' actual hours. So the government gives us these other options on counting the hours for purposes of health coverage. The difficulty, clearly, for schools and colleges, the difficulty will be, and there's been a lot of articles written on this, counting the hours for adjuncts. All right, and I know a number of schools are going through trying to figure out how they categorize the adjuncts, because typically they're crediting based on courses taught, not hours worked. And the government hasn't provided great guidance here. There have been letters written to the government to provide better guidance. Nobody expects we're going to see better guidance before 2014 on how you count hours for adjuncts. So really, it's a good faith effort where you're looking at not only the hours where somebody might teach, but also the hours outside of the classroom, preparation time and time spent on grading exams. All right, so you need to come up with a reasonable method to determine hours for categories where you don't know the hours worked. And the only guidance the government gives us really is you can't come up with a method that will specifically exclude them. You need to come up with a reasonable method to determine whether it's full-time status or not. Yes?
So earlier when someone asked the question about flexible spending accounts, you said the 2,500 limit applied to not only the health care, but the dependent care, but that's not my understanding. That's still 5,000. You want to clarify that?
Yeah, it's 2,500 per individual. That's right. That's right.
Right.
The
So
household
for a
five.
married couple,
Yeah.
it's 5,000. Thank you.
Right. It didn't affect dependent care.
Okay. Thank you.
It didn't affect dependent care.
The $2,500 is on the traditional flex.
That's right. On the traditional flex plan, which used to be 5,000. Right. Does that help?
Yes, it does. Thank you.
All right. All right, so what you need to be doing currently is going through your employee demographics, go through your payroll records to identify full-time status. All right, that's a starting point for you so that you can identify if there are individuals that are not covered that you will need to cover, and possibly come up with new types of classifications of employees as well, so that you can make sure you're complying with the law for next year. All right, now,
If you have an employee who works over, let's say, 30 hours a week, but only for an academic year, is there a coverage requirement there or not?
absolutely, absolutely, because in effect, it's paid time off the summer. It's really paid time off, and it does state in the regs that you have to cover them, even though they're they're getting that time off. All right, now, keep in mind that there's eligibility requirements. In Massachusetts, it's a lesser eligibility requirement, but federal law provides that you can't have a waiting period longer than 90 days. All right, and I think everybody should be in compliance with that, given that Massachusetts is a shorter period. All right, now, here's where we get into the shared responsibility of the pay or play. And there's a lot of detail in here, and I'm going to only highlight what the law relates to here. Yeah, Massachusetts, I believe it's a 30-day wait at most, or 60. It might be 60. Yes, I think 60 at most in Massachusetts. All right. So the shared responsibility, which is the tax piece for noncompliance, impacts if you don't provide minimum essential coverage for at least 95% of full-time employees, or offer coverage that is unaffordable, or coverage that does not meet minimum value. If you fail to provide any of these three categories, then you will be subject to the new tax. All right, and this begins in 2014. All right, for minimum value, the plan must provide at least 60% of the total allowed cost of benefits for full-time employees. Now, the insurance companies have called on their actuaries to calculate the 60% minimum value. So for anyone trying to determine are they providing the minimum 60% value, you need to speak to the insurance carriers to make sure that you're within that range. All right, affordable coverage, the cost for individual coverage can be no more than 9.5% of the employee's household income. Now, obviously the problem here is you have employee data, you don't have spousal data to know what the household income is. The government says as a safe harbor you can use the employee's W-2. So what you need to make certain of is that for your lowest paid full-time employee, that you have an individual plan available that costs no more than 9.5% of the person's W-2 comp. Now, it doesn't mean the individual has to select it. It just means that you have to have that available. All right, now, if an employer fails to offer at least one employee minimum coverage for a month, and that employee goes to one of the insurance exchanges, all right, or takes the tax credit, all right, in that case, then the employer is subject to a penalty. All right, now, if the employer has met these three, the providing of minimum value, affordable, and minimum essential coverage, if the individual goes to the exchange, there'll be no tax due. But if the employer does not meet those three standards and an employee goes to the exchange, then there is a tax due equal to $2,000 times the number of employees. All right, and then this is divided by 12 and paid monthly. All right, but again, some employers are finding it's cheaper to pay the $2,000 per employee rather than provide the coverage. All right, so it's a decision that each employer has to make. Of course, if you're currently providing insurance and now you're going to cut your benefits, well, you might have issues with your employees. So you do need to go through the planning now to determine what are you going to do with your health insurance going forward. All right, now, the $2,000, the government allows you to subtract out the 30 employees so that there's a little bit of savings there in calculating the $2,000 penalty. All right, and again, this would be paid monthly. All right, now the other tax would be that if it's not affordable coverage, then there's a penalty of $3,000, and that's not based on total employees. That's based on only the ones impacted. Now, since you failed one of the standards, then the government provides that you pay the lesser of the $2,000 times all the employees, or the $3,000 times the number of employees impacted.
Well, I just had a question. Is the 9.5%, it's the employee's share, right?
That's the employee's wages.
It's not the total cost.
We're looking at the employee's wage, and the insurance for your individual coverage cannot exceed 9.5% of the wage.
The total cost of the insurance or the employee's copay portion of the monthly insurance?
It's the premium plus any contributions they may make to the HSA or HRA.
Okay.
All right, now, as I mentioned, there's more details here regarding these penalty taxes. All right, and you can read that on your own later. But again, there's so much detail that we still are waiting for on this. But I'm trying to provide some general guidance for you so that you can then go through and do some planning.
Bernie, just a thought following on to that question. Have you kind of computed what maybe the minimum is on a minimum wage employee, minimum wage? It seems to me we could mathematically do this and create a floor and then compare it to our.
Yeah, that's what you need to do. Take your lowest paid employee and then take the premium for the individual policy, divide it by the wage.
I guess if the employer's paying for it, isn't it automatic?
If the employer's paying it in full, yeah, you don't have an issue.
Free single coverage, you're meeting 60%.
Yeah.
Meeting the test. So if you had somebody making, what's minimum wage? $14 an hour. So, but if you did, what's minimum wage? $9, $8?
Eight.
Is that, so what's that, $125 a month? So if you were charging your employee more than $125 a month for single coverage, it would look like you're in trouble. Is that fair math?
We use working brothers as a base.
Is that where you're going?
Right, so it's not my share. If I'm paying
That's right, it's not your share.
20%, it's only theirs.
That's right, it's the cost to the employee. Exactly, it's the cost to the employee. And again, if anyone is out of compliance with that, you can simply get have an individual policy available that meets this standard. And it doesn't matter if the employees use it, as long as it's available, then you're complying with the law. Now, the way this tax will be paid, you will receive notice from the IRS. Basically, you'll get a bill from the IRS that you owe the tax. So it's not a case of where after you've done your work and you find you're not in compliance that you're going to complete a tax form and voluntarily pay the tax. So my guess is that the taxes will not be paid until early as 2015, after the IRS starts gathering some data on usage of the exchanges and also on compliance with these minimum standards. All right, now going forward, there will be an excise tax, but again, we don't have to worry about this for now, but if you're redesigning plans, you might want to keep this in mind. This is the Cadillac tax. If you offer a Cadillac program, this is going to be a 40% excise tax on that. All right, you can see the premiums are pretty high before that comes into play, but do adjust, you might want to adjust your plans now.
Is that going to be adjusted for inflation?
Yes, it will, but I don't think it's going to be adjusted in the first year. I think that's the limits we're dealing with for the first year. All right, now, more important, what you need to keep in mind is there will be non-discrimination rules related to health insurance. There is a provision in the law that says you cannot discriminate related to health insurance. It's been there forever, and there's never been any regs on it, so we've always ignored that because there's basically no impact. But in the new law, they do provide that there will be non-discrimination regs issued. We don't know when. Once they're issued, then the non-discrimination rules will be effective. Now, what this means is you won't be able to provide greater coverage. I'm sure there'll be ranges for highly compensated employees versus non-highly compensated. Now, I would suggest to you, though, and I've seen this come up recently, where in negotiating contracts for your key people, I don't think you should be providing retiree health coverage for only your key people. So you should look at, because clearly at some point the non-discrimination regs will be out and you won't be allowed to do that. So if you're currently negotiating contracts, you may not want to include retiree health coverage only for your keys. All right, that'll be a violation of the non-discrimination rules, and then it'll come into play in 409A, which is your non-qualified deferred compensation rules as well. So it will become a big mess if you're providing the health care only for the retirees that are key. All right, so with that, just a quick summary, and again, it's just limited time to go into all of this, and there's so much there. You need to see if you have to pay this PCORI fee by July 31st, and I'd start gathering the data on who's covered now so that you can pay it. Limit your flexible spending accounts. Make sure you check your payroll so that you're providing that additional 0.9% tax for Medicare. Review classification of employees and the hours of service now so that you can get in compliance with the Act if you choose to be in compliance. And then I suggest that you should do compliance testing now for next year to know that your plan is designed the way you want it to be, whether it's intentionally out of compliance so that you pay the tax or whether you want to redesign the plan so that you are in compliance. All right, so with that, if there's any questions, I can take a couple, I think, right now, or I'm sure after Ed speaks, we'll have time for some more.
Hi, Brittany. We were told that for the PCORI fees, that we have self-funded options under Blue Cross Blue Shield. That's not self-insured, right? Do you know?
were told what?
That they said you could elect self-funded plan as opposed, and is that something that's subject to those PCORI fees?
Well, aren't you referring to self-insurance where...
It's not self-insurance. They said it was self-funded. It was Blue Cross Blue Shield. I don't know if that's...
I'm not sure what you're referring to with self-funded.
Okay.
Are you paying anything out, Ed?
I think you're talking about this new Blue Cross Blue Shield plans for small, under 200 employees.
Yeah.
Those plans will be self-funded. There's a self-funding component, so you will have to pay the PCORI fee. And they may file that for you, but you are going to be responsible for it.
I don't think Blue Cross is filing those forms, but you need to check.
Okay. And the other question, the Cadillac tax is a $10,000 limit. Is that for the entire cost of the premium, or is that for just the portion that the employee pays?
The $2,000?
No, the Cadillac tax.
Oh, the Cadillac?
Yeah, is the
Oh,
premium?
that's
Is that the
I
total
think
premium?
That's the total premium.
Total.
Yeah.
Okay, thanks.
That's the total premium on the Cadillac tax. Pardon? Yeah, but it's going to be passed on. It's going to be passed on to the employer.
And the increased Medicare tax on the 200,000, is that in excess of 200,000, or then becomes retroactive to $1 on the employee?
Well, it's an additional tax, so I mean you can start paying it any time you want. It's only once the earnings exceed 200,000. But if you knew that they're going to exceed at the beginning of the year, you could prorate it over the year. Any other questions? Well, one other question.
On these rules about 9.5%, et cetera, that's all on an individual plan?
Pardon?
The rules governing minimum coverage, that would be on an individual plan, correct?
That would be, yes.
Okay.
Yes. I think we have one more.
We were waiting on a minimum wage person, $8 an hour, full-time. That would be $131.73 a month. I suspect there are very few employers that are charging for single coverage that exceed that level. So you're probably going to get through that one with relative ease. And it's going to be the insurance company 60% factor. I think you're going to have far more issues with who's in and who's out.
Yes.
Versus your plans meeting these minimum standards.
I would agree. All right, one more question, and then I have to turn it over to Ed. It's 40%, I believe, of the premium.
Of the total premium?
Yeah,
not-
of the total premium.
Not the excess over those amounts?
Of the total, I believe, yes. But again, we need more guidance on all this, and that's 2018 that we have to be concerned about that. It's on the costs over that, over these limits. Costs over $10,200 per individual, costs over $27,500 per family.
It's only on the excess. It's not on the entirety.
So it's on the excess.
So 10.2 and 27.5, 40% on the excess.
All right, so with that, I want to turn it over to Ed.
Good morning, everybody. Let's see. I'm going to need my glasses because I have notes. I can read the screen without the glasses, but not the notes. The first thing I wanted to mention was on the Form 720, if you have a health risk reimbursement account, you may be required, if it's not integrated with your plan, and there's a definition for that, you may be required to file the 720 form for your health reimbursement account. So you need to take a look at that. When I think about the healthcare reform bill, when it first kind of came out, it reminds me of a story that one of our underwriters told me about her son. Our underwriter, degrees in math and that kind of stuff. Her husband's a CPA, so they're both pretty good in math. One day she was at home and her son came into the room and asked her, "Is Dad home?" She said, "No, he's not home." And so he went away. A few minutes later, she said, "Is Dad home yet?" She said, "No, can I help you with something?" He said, "Yeah, I need help with my math homework." And she said, "Well, I can help you with that." And he said, "I don't want to know that much about it." I think the healthcare reform bill is something that we can't afford not to feel that way about. If you haven't started to take a serious look at it for your organization, it's probably getting late. I would say that most of the responses we received on the survey, for those of you who had the opportunity to respond, said that you are feeling that you're very prepared to somewhat prepared. There's a lot of space between those two, as it says somewhere as far as the east is from the west. So it's really important at this point to make sure that you are taking the time within your organization to take a strong look at how this bill is going to affect you. Today, I'm going to try to go through this agenda, which is to give you a to-do list. And if you can check most of the things on that to-do list off, wonderful. If you can't, you need to talk to us or someone, because this to-do list is not optional. The Internal Revenue Service has been charged with implementing, policing, and enforcing this bill. And even though, they do it through phone records, from what I understand, it's something that you need to pay attention to. The Affordable Care Act is not a standalone piece of legislation. Much of what the Affordable Care Act accomplished, it did so by amending other law. For example, if you take a look at the labor laws, Fair Standards, what is it called, the FSLA? If you take a look at that, it amended that law in parts. It amended the COBRA law. So when you take a look at compliance issues for the Affordable Care Act, in addition to the things that Bernie reviewed, you really have to consider that there are other aspects of compliance that are going to be impacted, and you have to make sure that you're looking at this on an integrated basis. So I'm going to talk about that real quickly. Preserving value. We've talked a lot about what the minimums are. And some people said that the Affordable Care Act was going to create a race to the bottom. You remember that comment? Well, what about the top? Your organizations depend on high performance and productivity. How are you going to help people who are working for you, who you want to continue to encourage to perform at a high level, to see health insurance as a highly perceived benefit as it is today, when it's now a mandate? So that's under shared responsibility and discussion. I'm going to spend a brief minute, even though it's the biggest part of the outline, to talk about the health insurance markets, because the changes that are occurring and have occurred in the health insurance markets, especially here in Massachusetts, we're ahead of the rest of the country. with the exception, God bless you, with the exception of maybe Minnesota and Oregon, we're ahead of most of the rest of the country. But the changes that have occurred on the supply side of healthcare are going to drastically change the kinds of benefits that you can offer to your employees and the kind of choices they have. And we're going to take a look at that. So we're going to take a look at supply side market reform, some new business models, new incentives, and what that's going to drive. And then finally, the exchanges are really not new to Massachusetts. In fact, the federal government recognizes that the Massachusetts model, which they used, is really in some ways different and better than what the federal model is, and so there's a phased-in approach here in Massachusetts as opposed to other states where it's going to all happen on January 1, 2014. That phased-in approach is still a matter of debate, by the way. There's still some negotiating going on regarding certain aspects of the implementation. And then finally, my favorite piece of this is plan optimization. So testing is only the beginning. Remember that Chicago song? Only the beginning. Anyway, it's only the beginning. First of all, the law, it continues to evolve, continues to change. As Bernie said, we're still learning what kinds of things we have to deal with in many ways. Plan optimization is really the challenge, in my opinion. That is, how can you take the benefits that you offer and continue to make them benefits? How can you continue to provide value, and how can you continue to do that in a cost-effective manner for your organizations? This is our way of looking at health reform. These are, from a to-do list point of view, this is the universe of things that we think are important for you to consider. It's like a clock. It starts with testing. Those are the things that Bernie talked about in some detail. I can tell you that we've started doing testing for many clients. And as we get into the numbers, in many cases, we're surprised. I've got a question for you. Please raise your hands. Please don't be shy. I really would love to see the hands. How many of you in the room are currently, your organizations are self-insured? Could you show of hands? Wow. Everybody else is fully insured? Wow. Partially. Okay. Okay. So, so I should have asked that question. It's a very good point. So how many of you are partially self-insured? Okay. So I would say that 87.3% of the room is fully insured. So that's going to kind of slant my presentation. There's a difference in terms of the testing, but collecting the data is extremely important. And I just want to spend a second on that. The data that you need is going to come out of your payroll system and your HRIS system. The data that you need to collect needs to be collected in certain ways, and you need to make sure that however you collect that data, it's easy to do on an ongoing basis. Because collecting that data, reporting that data, and using it in testing is an ongoing process, not a one-time process. Plan optimization I talked about a little bit. By the way, for those of you who are partially self-insured, we call it hybrid solutions. But if you're fully insured, the insurance company will take care of it. That's going to be very expensive. It is estimated in Massachusetts by the carriers, by Tufts, by Harvard, by Blue Cross and Blue Shield, that the average rate increase for small employers, that is less than 100 employees, is going to be somewhere between 12 and 15%, just as a result of the Affordable Care Act, before we even talk about claims experience. And for larger employers, that's going to vary, but probably somewhere between 5 to 7%, just because of the Affordable Care Act. So it may not be a good idea to just relax when the insurance company says, we'll take care of it. I would suggest that you really want to take a close look at what that means. Plan optimization includes things like plan design and how do you integrate things like wellness and so forth, but it also includes what Bernie talked about. If you think of the options you have with health reform on a continuum, the most you can do is probably what you're doing now. Many of you are very generous. I know that for many nonprofit organizations, benefits are extremely important as a part of compensation, even more so in some cases than in for-profit industries. So in that case, if you want to maintain a fairly high level of benefits, you're probably doing more than the law requires. And as far as minimum essential coverage is concerned, and as far as the 9.5% affordability test, most of you are probably on the high end of the scale. If we look at your plan valuations, you probably offer a gold or a platinum plan to begin with. And largely in part because mass health reform, I think, addressed that earlier on. So I think that the point that Mike made, that most of you are going to see that your problem is going to be in how you define the 30-hour issue, is going to be extremely important, not only for colleges and universities that are dealing with adjunct professors, but also people that have what I call dynamic payrolls. Payrolls in which you have a lot of seasonal employees, temporary employees, per diems, employees that don't fit nicely into a 40-hour week. And so drilling down into that data and figuring out two very important things for next year are critical, and you need to do that soon. One is called a stability period, and one's called a measurement period, and you need to make sure that you understand what slice of time you want to look at for the purposes of doing your testing and understanding who's full-time and who's part-time and who's going to have to be covered and not. And that's something that requires just drilling down into the data. Compliance. Compliance is an ongoing process, as I mentioned. In addition to federal laws, there are state laws that are involved. There's Medicaid expansion in the state of Massachusetts, and if you're in multiple states, every state has a different twist on this. You may be operating in a state that has decided not to expand Medicaid. That's going to have a significant impact, potentially, on the number of people that you're going to have to cover under your health plan. So it's important to have systems, whether you buy them, build them, or contract for them, whether you use Outlook or Excel or Access, which I wouldn't recommend. You need to have some kind of systems that integrate with your payroll system, that take all of the 17 pieces of legislation from ADA to USERA and understand what the deadlines are, what the notifications and filings are. You need to make sure that you understand how those things, how those deadlines come up and the filings come up and those things are tracked. And that brings up a point. Many people I've talked with have said, well, HR is handling that. Well, guess what? This is something that's going to require coordination between your finance department, Bernie said this, and your HR department. And if you have a tax department, your tax department. Because in most cases, your HR department doesn't do the 5500 filing. In most cases, they're not the people that manage the taxes. So you need to make sure there is an internal communication process, workflows that take into consideration the cross issues with respect to compliance. Finally, if you take a look at the bottom, organization and vendor readiness, you need to make sure that your payroll company is compliant. You need to make sure they're providing you with the reporting and the data that you need. So when you look at that bottom piece there, it's really important to make sure the vendors you're using for COBRA administration, for Flex administration, payroll, HRIS, those things that the data is integrated. If you have different vendors, that's fine, but you need to make sure that you have them integrated. Risk management, I'm not going to spend a lot of time on that because there are fairly few people in the room that are self-insured, but if you're self-insured, you do have some options that fully insured employers may not. That includes things like getting involved in co-ops and captives. Captive reinsurance is a very important option for some of you. Joining with other employers, the federal law actually encourages it. In addition to that, you're going to see in a minute that the opportunity for direct contracting with large provider groups is something that may be a viable option for your organization. And then finally, population management, which in and of itself you're probably already doing, but there's a new element to this, and it kind of leads us to another slide that I'll get to in a minute. I would say that if you haven't gathered the data, it really isn't that bad. We have a template. If you need the template, if you send us an email or something, we'll send you the template. But it's an Excel template because that's what most people use. That'll tell you the data that we would recommend you use for testing. Once you gather that data, it always has to be scrubbed, right? The data is always not clean. So you scrub the data and construct a database. The database is important because you're going to need this data on an ongoing basis, as I mentioned. The compliance testing is something that you can do the back of the envelope. I'll tell you what, let's do this. How many of you have either temporary employees, per diems, adjunct professors? How many people do you have that you're not sure of their hours or that might have variable hours? Can I see a show of hands? That's most of the room. Okay. I would say that that is probably the biggest problem. And the testing, what the testing should do is help you identify, if you take 2,080 hours and divide, you can get to a point, but you need to really drill down on that and understand how you want to manage your payroll. How many people currently think you have a 9.5% problem? That is where the individual cost of health insurance for your lowest paid employee exceeds 9.5% of their pay. How many of you think you have a problem? I just see one hand, okay. And I doubt any of you have a problem with minimum essential coverage because you're in Massachusetts. But let me talk a little bit about minimum essential coverage. The plan valuation is done using an algorithm that was established by the Department of Labor. It's available on their website. If you simply Google, or Bing, whichever, if you simply Google minimum essential coverage, you will be taken to the DOL website, and they actually have the algorithm there. You can download it and you can run your numbers. It's a little bit misleading. For example, we had a client say, well, gee, I have a $2,000 deductible, and I've got an 80/20 after that, and I've got these co-pays. Do you think my plan is probably bronze? The plan ended up being platinum because of the other limits. So there are various combinations and permutations you can use to get to the plan valuation. But just knowing what your score is important, if for no other reason. Maybe it gives you bragging rights to your employees. Because wouldn't it be nice to be able to go to your employees and say, hey, by the way, we're giving you platinum coverage. And I bet most of you are. So the plan valuation is something that you can do fairly easily if you take the time to go to the website and download the algorithm. So once you do that, you need to present your findings to somebody, probably your boards or to your executive committee. But those findings need to be presented so that you can understand what the financial impact is to your organization and what the employee relations impact is to your organization. And then you need to establish a strategy set, that continuum I talked about, doing the most, doing the least. Doing the least is saying we're getting out of the health insurance business altogether, we'll take the $2,000 hit, which is not tax deductible, and those are the two ends of the continuum. But there are lots of options in between, and most of you are probably not going to just terminate your plans. In fact, recent Towers survey indicated that most employers are probably going to continue their plans at least until we know what's going on with the retail exchanges. So you need to figure out how you're going to come up with the plans that are most cost effective and give your employees the best value. Implementation administration, you need to figure out, as I said, how you're going to manage this and how you're going to continue to comply. And then you need to make sure that you're doing employee communications appropriately, because employee communications are part of the mandate. There are specific things the law requires you to do, notifications and disclosures, notices that you have to send out to employees regarding exchanges and Medicaid and all kinds of things. So you need to make sure that those are scheduled and that they can be sent out on email blast or however you communicate with your employees. That needs to be scheduled and planned. And then finally, you need to make sure that that's some way codified, because if you're ever audited by the IRS on this issue or the DOL, you need to have that plan in place. So this is just kind of a schematic, and by the way, that probably should be a loop more than a straight line. Shared responsibility, I love the term. I don't know how long it took them to think this one up, but shared responsibility in this case really means you. If you take a look at the 2,400 pages of the law, what you're going to find is the shared responsibility provisions mainly speak to employers. There's very few pages that speak to employees. In fact, it's about a half a page. The employees have to have coverage. You have to provide it. So when we look at shared responsibility, we think there's an opportunity here to have a conversation with your employees. And we think that conversation can be very constructive and lead to better relationships. Right now, what you give your employees is a benefit. After January 1, 2014, it's a mandated, it's a tax. So the question we have is, are your employees going to look at health insurance differently? So we ask you, these questions. And I always like to see the people that are in the room, what they think, and I want to watch my time.
You got 10.
Thank you. So I'm going to go through this data pretty quickly. But we asked you in the survey, how many of you think your people are either aware and informed about the Affordable Care Act, unaware and uninformed at the other end, and aware but uninformed? These are the results. Aware and informed, 0. Aware and uninformed, most. I think that's probably true. So at this point, your employees know there's something out there that, real quick, I got to tell you this. My son is 26 years old, 27. He just came off my coverage. And I said, Chris, you have to send in this COBRA thing. He said, yeah, I'm bulletproof. He didn't say that, but that's what he said. And so I said, okay, about a week later, Chris, did you send in the COBRA payment? I don't need it. He said, by the way, in January, I'm going to be all set. I said, why do you say that? He said, I'm going to be all set. I'm going to be on Obamacare. Well, we had a long talk. But the point I'm making to you is I bet you there are a lot of your employees that feel the same way. So it's important to have this discussion with them. Secondly, capable. We asked you, how many of you think your employees are going to be capable of managing the purchase of health insurance? How many of you have been to the connector? How many of you online? Okay, I'm going to ask you, do me a favor, please do this. Go online and look at the Mass Connector. You know your people. Then go back and think about how many of them could navigate the connector today. How many of them could do this? I think you're right. You said 15% of your people are going to be capable to do this on their own. Here's a real quick one. How do you expect the ACA to change the way your employees and their families perceive health insurance as a benefit? 21% of you expect that it's going to improve the relationship, 45% expect no change, 34% reduce. I'm going to skip this one. This is my favorite one. Okay, now I'll tell you why this is my favorite one. If you see the gold bars ask the question, how many of you think health insurance is important as it pertains to attracting, motivating, and retaining employees? The green bars reflect how many of you think health insurance is important as a function of motivating people to be more productive. So I'm really confused because I think there's some reconciliation we have to do. Many of you said that in terms of attracting, motivating, and retaining, it was the second to wages most important issue. But when it came to productivity, not important at all, a whopping 64%. I think that it's because of the way we think of health insurance benefits and the way we use them. I think there's an opportunity that health insurance reform gives us. I'm going to skip a couple of slides here. I'm going to talk real quickly about plan optimization. The rest of the slides I'm going to talk about how you can take advantage of, leverage the changes that are occurring in the market to optimize your plans. That is, make them more efficient, enhance the relationship with your employees. Here are the major trends we see. Right now, affordable care, right now health insurance is not affordable. Right now health insurance is employer-centric. You make the decisions, you tell your employees in open enrollment, this is what we're going to provide, you're going to have 3 options, this is how they're going to be priced. Pick one. Under the Affordable Care Act, people are going to be able to go online and find out how your plan compares to the plans they could buy retail. The impact that's going to have, question mark, question mark, question mark. By the way, I skipped one. It's a mandatory offering. As you know, it's voluntary now. The impact is compliance, increased demand, because there will be people that do not have coverage that will all of a sudden be eligible. And finally, I think there's going to be a diminished value impact. Fee-for-service today. Everything we do in healthcare is fee-for-service. You go to a doctor, you have a procedure, you get a bill, you pay the bill, the insurance company pays the bill. That's all going away. And as of January 1, and gradually as we go forward, and that's already started, global reimbursement, outcome-based, ACOs, you name it, there's a new language. And the question is, how is the relationship between insurance companies and providers going to impact the way you see data, use data, manage data that drives your cost? It's going to definitely have an impact on data and behavior because there are new incentives for the providers. The providers now have to be more efficient. Are they going to change the way they operate? Finally, currently health plans have members, right? I belong to Harvard, I belong to Tufts, I belong to Blue Cross. In the future, provider networks are going to have networks. So there's a shortage of doctors, primary care in particular. And I think what's really fascinating is, if you've been paying attention, it's really interesting in Massachusetts, we already have a merger panacea going on. Chief Executive Officer of Partners, the state's largest hospital and physician network, confirmed the existence of the inquiry regarding the purchase of South Shore and Weymouth. The note underlined in red, this is his comment. The company recently entered the health insurance business. This is Partners. This is, by the way, this is like, I don't know, a couple of years old. So the provider side, this is Partners doing an agreement with Harvard. Fallon. So my point to you is that the providers, the supply side of healthcare, they've been prepping for this for a long time because federal money's been flowing for all kinds of experiments. You know that dollar fee, the Patient-Centered Outcome Research Institute fee? It's a research fee. These are experiments. We have no idea whether or not they're going to impact health costs. We hope they will. But you're paying for research in many ways, and your employees are going to pay for it. So I'm going to refer you to a reading list. There's a journal published by Harvard. It's called the Strategy and Business Review, 5 minutes. I would just say that they've been talking about the healthcare, the retail shift in healthcare for a long time. It's occurring. You need to take a look at that. Finally, what's starting to happen is your employees are going to have new benefits, new options. They're going to be looking at, I think I want the Blue Cross Gold plan, but it only has these providers in it. It doesn't have those providers in it. So your employer, and many employers are already doing this. Is anybody in a tiered network plan now? One company, okay, 2, 3. So you're already dealing with the fact that your employees are now not only choosing deductibles and copays, they're now choosing, oh, by the way, the provider I want, some of them are in this network, in this plan, but some of them are not. It's a new discussion you need to have with employees. Telemedicine, biometrics on our mobile phones now, we have more information and potentially access to more information about our health than we ever have before. I talked about health data. I can't overemphasize this enough. If you're self-insured or fully insured and you're used to getting a claims listing, my point to you is the claims listing is going to have very little value if most of the provider arrangements are being based on reimbursement contracts that are capitated. So it's important to understand that. The behavior modification, we've played with wellness to this point. Most employers don't have a serious wellness initiative in their place. There are ways to engage people within this concept, within that continuum of options for plan optimization. We think it's a very important aspect of what you should be doing in your plan design. There are rules within the Affordable Care Act regarding how you can implement and charge and so forth. You need to understand if you have a wellness program that it needs to be a qualified wellness program. You also need to understand the extent to which you can charge the way you're doing now, because you get a year, 2014, they let you do what you were doing before. 2015, you have to change it. That's the continuum. I'm going to skip that. Any questions? Thank you very much.